Tonight, if you're a cattle producer or a grain farmer, this market just sent you a signal, and most people are going to read it wrong. The screen looked calmer in a few spots today, but underneath it, pressure is building in ways that could hit your operation next. Crude oil broke hard, hogs got hit, corn slipped, and even with feeder cattle holding together, this does not feel like a stable market. It feels like something is shifting, and the question is whether that shift helps you or starts working against you. Because right now, this isn't just about prices. You've got disease risk building in cattle, policy pressure building in inputs, and early signals coming out of the fields that could change how the season plays out. And if you only glance at the board tonight, you're going to miss what actually matters. The broad tone from today's headlines is that grain and livestock futures saw a risk-off sell-off tied to easing war fears. That was one of the lead themes across the market today, and you can see that idea all over the board. Crude oil got crushed, corn slipped, oats were lower, lean hogs were sharply lower, live cattle were basically flat to slightly lower, feeder cattle managed to close higher, which is worth noting, but even there this does not feel like carefree bullishness. This feels like selective resilience inside the market, still trying to decide how much outside fear belongs in the price. Before we get deeper into it, I want to say this early in the show. If you want daily ag updates that cut through the noise and stay focused on the markets that feed America, make sure you like this video, subscribe to the channel, and stick with me Monday through Friday. That support matters more than you know, and it helps build this into a daily report that is actually useful for producers. The first big idea is this risk-off move. When the headlines say war fears are easing, markets that had built in a premium for geopolitical danger often start giving some of that premium back. That does not mean the world suddenly turned safe. It means traders decided part of the previous fear was worth a little less than it was yesterday. That is an important distinction. It is not the same thing as saying all the danger is gone. It is more like the market stepping back and saying maybe we got a little too aggressive on the fear bid, so let us cool that off for now. That cooling off process tends to hit crude oil first and fastest, and that matters because energy often sets the emotional tone across commodities. Even when a direct impact does not show up immediately at the farm level, sentiment shifts begin there. And tonight, that shift was aggressive. Crude oil at the time of recording this podcast was trading near $96.50, down $16.45 on the session. That is not a normal move. That is a repricing. A break like that changes how traders feel about risk across the board. It signals that money is pulling back from fear-based positioning, at least for now. And when that happens, other markets tend to follow, whether they should or not. Corn was trading near $4.47, down about 1 penny on the day. Soybeans were near $11.61, up about 3 cents. Oats were near $3.32, down 9 cents. Feeder cattle were near $367.88, up about $1.25. Live cattle were near $245.75, down about 5 cents. Lean hogs were near $104.65, down about $2.40. So when you look across the board, this was not one clean story. Soybeans held together better than corn, feeder cattle held together better than live cattle, and much better than hogs. Crude oil was the biggest mover by far. That tells you the market was repricing fear and outside risk more than it was trading a pure grain fundamental story. Now step back and think about what that means from a producer standpoint. When markets move like this, it is easy to focus only on what changed today. But the more important question is what is starting to build underneath. Because markets rarely move cleanly from one thing to another. They rotate. Right now, one source of fear, geopolitical tension, may be easing just enough to pull some premium out. But at the same time, multiple other pressure points are building, and those are much closer to the farm. One of the bigger structural shifts showing up right now is USDA establishing a national proving grounds network to test ag tech and AI-driven tools. That might sound like something that sits far away from daily operation, but it should not be ignored. When USDA begins building a formal system to test agricultural technology, that signals a shift toward institutional adoption. It means these tools are moving beyond experimentation and into something more standardized. For producers, that creates both opportunity and risk. Better tools can mean better decisions, improved efficiency, and stronger margins. but it also raises the question of who those tools are being built for. There's always the risk that innovation becomes more focused on theory than practicality, that solutions look good on paper but do not translate cleanly into real-world use. So while this move signals progress, it is something producers should watch closely, because the real value of technology is not how advanced it is, it's how usable it is in the field. Another major area of pressure comes from regulation. USDA finalized update to the National Environmental Policy Act regulations, and while that may sound like a technical adjustment, it has real-world implications. Regulatory frameworks shape how quickly projects move, how much uncertainty exists, and how expensive compliance becomes. That affects everything from expansion decisions to infrastructure development. The key question is not what the rule says on paper, it is how it plays out in practice. Does it simplify the process? Does it create clarity? Or does it introduce new layers of delay and cost? Those are the outcomes that matter. At the same time, pressure is building around pesticide policy and labor. Farm groups are pushing for science-based pesticide reviews, and that tells you there is concern about how decisions are being made. Producers rely on consistency when it comes to crop protection tools. If that consistency starts to break down, planning becomes more difficult, and uncertainty alone can create cost. Labor shortages add another layer to that pressure. Labor is already one of the biggest constraints across agriculture. When it tightens further, flexibility disappears, operations become more fragile, and every disruption becomes harder to manage. Then you layer in the right to repair issue. Deere and Company reached a $99 million settlement related to right to repair litigation, and this continues to be one of the most important structural conversations in agriculture. Modern equipment is powerful, but it is also complex. And with that complexity has to come a shift in control. When producers do not have full access to repair tools, diagnostics, or software, it creates dependency. That becomes a problem when timing matters most. During planting or harvest, delays are not just inconvenient, they are costly. So this is not just a legal issue, it's an operational issue. The settlement signals that the issue is real and significant. But what matters next is whether it leads to meaningful change, because what happens in the field matters far more than what happens in a courtroom. Now shift into livestock, because this is where one of the most important stories right now is developing. USDA has launched a $100 million initiative to address the spread of New World screwworm from Mexico. That level of funding signals a serious concern. This is not a minor issue. Screwworm is a direct threat to animal health, and if it spreads further, it will impact management, labor, and cost. For cattle producers, this adds another layer of risk that has to be monitored. It means paying closer attention to animal condition, treatment protocols, and overall herd management. Feeder cattle held strong today, trading near $367.88 and finishing higher. That shows there is still underlying support in the cattle market, but support does not eliminate risk. If a livestock health issue begins to escalate, sentiment can shift quickly. And that is why the story matters. It may not be fully reflected in the market yet, but it has the potential to become a much bigger factor. On the crop side, the first red crown rot infection of the season has been reported in Minnesota soybean fields. Early disease signals are important because they change the conversation. They shift attention from potential risk to active monitoring. This does not mean there's a widespread issue, but it does mean conditions exist for disease development. And that is something producers need to watch closely as the season moves forward. Looking at crop progress, about 3% of the U.S. corn crop is planted, slightly ahead of the 2% average. It is early, and the number does not define the season, but it signals that planting is underway, and the market will begin shifting toward real-time field conditions rather than expectations. Weather continues to be a factor, especially with dry conditions creating fire concerns from Missouri to the Great Lakes, and red flag warnings in southern plains. Fire risk is often overlooked, but it can be highly disruptive. Wind, dryness, and field conditions all contribute to that risk, and it is something producers need to stay aware of. At the same time, global fertilizer markets are showing stress with urea prices rising sharply since late February. Even if that pressure has not fully hit U.S. producers yet, moves like that influence expectations. They shape planning decisions and can impact how input costs are viewed moving forward. When you put all this together, today was not about one single story. It was about a shift in tone. Some geopolitical fear came out of the market, but multiple other risks remain active. That is the key takeaway. Now here's a quick market recap. Corn was trading near $4.47, down about a penny. May soybeans were trading near $11.61, up about 3 cents. May oats were trading near $3.32, down about 9 cents. May feeder cattle were trading near $367.88, up about $1.25. June live cattle were trading near $245.75, down about 5 cents. June lean hogs were trading near $104.65, down about $2.40. And May crude oil was trading near $96.50, down about $16.45. That is where markets were at the time of recording this podcast today. And the bigger takeaway tonight is simple. Some fear came out of the market, but the pressure has not disappeared. It has just shifted. If you want daily updates on the markets that feed America, subscribe to Boots and Bushels, and I'll see you again tomorrow.